So thank you for showing up today. Today's topic is very important. It's about price and volume analysis. So what we as a trader do, most of us, we just focus on the price because that's what we see on the screen. Something moving up, Apple moving up from 186 to 186.50, etc. And then we forget, we forget a lot of things to analyze, to look at it, systematic way of doing things, and is strictly looking for the things uh, what we have trained ourselves to look at. So we um, just ignore things out of greed or impulsiveness, in hastiness. So something is going on inside us, and one of the thing is we forget to pay attention to the volume. So when we fail to pay attention to the volume, we are only looking at the half of the picture. So we're just looking at the. Imagine you go to buy Apple, and you look on the top, like there's a lot of apples there. So this example just came to my mind. The apples there, bunch of apples sitting on top, and then you're looking on the only on the top side, and then you forgot to look at the other side, and other side is just all messed up. So what would you do? So same thing, if you pay attention only to the price of 50% of the thing you're doing, and 50% you're ignoring. So this 1 hour, 15-minute session will explain to you why you need to pay attention to the volume, and there's more to it. So I'm giving you a heads up. So I'm giving you a heads up, and then you take it, and then you do your own research. So the way you need to learn, or I learn, is somebody says something somewhere, and the aha moment comes. I pick up the keyword. I pick up what the person is saying. I know he's not telling me everything. He's not my 24-hour teacher. He's just telling me things what he can tell me in that limited time period, and then up to me to go and do the research and further work on it. So that's what it is. So I'm trying to explain to you about the price volume analysis, and my trading improve once I uh, find out that, oh no, I'm only looking at the price. And then there's a various ways of looking at the price and volume. So sorry, the volume. So not only the price can move. Also, for the price can move in the extreme level, and then we are still chasing it. So think about it. Um, if a car which you know is supposed to sell for, let's say, 30,000, and it's selling at 60,000, would you still buy at 60,000? So think about that. So that's price. And then how many buyers are there? So that's the volume. So price volume analysis, volume relevancy. So volume is relevant, and you need to combine the volume with the price. So price volume analysis. Now, um, there is something called inside and outside. So you can do the research on this topic and learn downtrend cycle inside and downtrend cycle outside. So outside means the so outside is like day chart, so you're looking at the day chart, but inside you need to go inside of the chart of that bar, into multiple time frame, and then also dissect that candle to know where, at what time of the day, and where, which price zone the most of the volume was there. So in this way you would know where is the support and where is the resistance. So that's one thing. You need to really know where most of the price action happened, because if you look at the day chart, you're looking at one candle, you don't know where. So the stock moved from $10 to $11. So do you really know where most of the action happened? Um, at what price? So the action, the most of the time, that market traded during the day, it could have traded between $10.50 and 10.60. Most of the action was in between the 10.50 and 10.60. So we need to know. So that is inside. Same thing for uptrend, inside and outside. So what is revealed? So when we dissect the candle, then something is revealed, and what is hidden. So what is revealed and what is hidden? So what we are seeing? So we are seeing on the day chart, we're just seeing even if you plot the volume, we see the volume. So on a day chart, if you're plotting the volume, the day will come. If you're looking at let's say the market opens 6:30 a.m. Pacific, and you're looking at 7:30, so 1 hour. So 1 hour, there's a like 5.5 hours left in that day. So you have to understand during the 1 hour, the first 1 hour or 2 hours, how much is the volume compared to the normal volume at this time of the day, or compared to the overall day. So normally this market trades 1 million shares during the first 1 hour and is trading at 2 million. So that is the relative volume. So you need to understand that. Now, another thing, volume, it trades 2 million shares on average over the last 30 days, or whatever average you take, and then it's already trading at 1 million. So something is there, plus the way it's moving, the volume, the price action, all the things, support and resistance, and the trends and the breakouts, all that need to be analyzed. So volume analysis is an art and science, and we are looking for perfections, or we're looking for consistency. And there are anomalies and validation. So we need to train our brain to look for anomalies and validation. But what we do, we forget to look at from the anomaly side point of view, and only look at the validation point of view. So the way we think, so we have to constantly do, so not only learn the technical analysis or risk management, but you have to go very deep on yourself, how you analyze things when you look at it. So I will show you some slides which has nothing to do with the technical analysis. It has to do with you yourself. So I will explain to you. I'm not a psychologist, I'm not an expert in the area, so I'm just will give you some hints, and you need to look at it and note it, and then you train your brain. So it's like training ourselves. So we need to train ourselves. Now there's something called widespread and narrow spread. So I will explain widespread and narrow spread. So the spread is the difference between the open and the close, or at any given moment, the open and the last price. So the close price is the last price, or the last price is the close price for that time period. So the stock opened at 100 and it closed at 105. That $5 difference is the spread. So for some stock, $5 is too much, and for some is not. So it's all relative. So don't forget about that. Is relative. So just don't go in an absolute term all the time. So think about it, it's relative. So for something is $5 is too much. For some stock, the $5 is for $1,000 stock, $5 move is nothing. For a $50 stock, $5 it means too much. So widespread, narrow spread, and we need to remind ourselves. So the relevancy of volume. So ask yourself, why I'm only stopping at the price analysis. So why I'm only doing the price analysis and not doing the volume analysis also? Why? Because volume is the other part of the equation. Volume is where the buyers and sellers are fighting. The price, they're fighting for the price, but how many buyers and sellers are fighting? So think about it. Volume is the one where uh, based on the volume. So if you look at the support and resistance, so support and resistance is just a price range, but if there is no volume there, and a volume is very small, that support and resistance is not as strong. But if the volume is huge at that price, then that support level and resistance level is very, very strong. So think about it. If you are analyzing the volume and you're just not paying attention to if you're analyzing the price and you're looking at your chart, and then you're saying, okay, yeah, I see this it moves from this price to this price, and then it hit this resistance, and then it came down, or it hit the support and it went up, but forgot to look at the volume. So volume is important. Another is it depends how much time you have to trade and how much time you're devoting. So on my side, as I develop, I like to automate things and have resources also. So I have a um, tech background and the business background, and just doing this for last 15 years. I have programmed it, so I know the what kind of a resistance or what kind of support it is. So is it a strong support or a strong resistance? So all that is programmed. So when the data is fed, I come to know how strong is the support or how strong is the resistance and what I'm looking for. So think about this. Is volume is still relevant today? Is it relevant to the market I trade? So is it relevant to the market I trade? Maybe there's a market where the volume is not relevant. Maybe you're trading what is it? Fine arts. So you're trading fine arts, and the fine arts, maybe there's no volume there, but so to ask yourself where the volume is not relevant. So we are trading the stock, we are trading options, so the volume is relevant. And then you ask yourself, can it be applied to all types of trading? So the types of trading is the swing trading, day trading, you know, scalping, a long term. So um, is it relevant? Can it be applied to all investing strategies? So the strategies you're applying, maybe you're trading options, so option strategy. So is there a volume in the volume side? If this sometimes the stock is looking good, but when you go to trade options and then you see there is no volume, so maybe it's telling you something is not right, or maybe what you're looking is not, others are not seeing it, but you rather be on the crowd side than just a lone person. So unless you are very intuitive, so if you're very intuitive, then and it's over the history of your that intuition work, then maybe you don't need to analyze um, the volume. You the volume will come. So, and can it be applied to all time frames? So can it be applied to multiple time frames? So I trade multiple time frame. You need to trade multiple time frame. It's very important. So the successful traders, those who are on the top, they trade multiple time frames. They trade multiple markets. They trade multiple contracts, or they trade multiple units of shares. So think about it, multiple. They have multiple strategies. They have multiple options for the same. So they it's like they pull out things. So, and they are very flexible. So trade on um, the what is it for the different time frames. So I have started. I don't know how, if you cannot hear me, then Lakshman, I don't know uh, how I can communicate. So I'm typing this. I have started, and you can listen on the recording. So I have started. All right, you guys can hear me. All right. So power of wick. Another thing, power of wick. So wick is what the high and the low. So from the last price. So wherever it's trading from the last price and the high, and the lower is from the open price and the low of the day. So these wicks, this topic, upper and lower wick itself is a big topic. It's a big topic. So pay attention to the upper and lower wick, because that's where, based on the wicks, you can start to analyze and understand the support and resistance. So it gives you some hints. It's not only, but you have to not only the upper and lower. So upper and lower wicks, they are telling you the price, right? So upper and lower wick telling you the price, but the volume is, if you're not reading the volume, then you're ignoring again the 50% of the equation. So the wicks are giving you the resistance level and the support level. So upper wick is the resistance, lower wick is the support. But if so, it's a heads up. So big give you the heads up, but if the volume is not there, then you just got the 50% of the heads up. So think about that. So relevancy of the volume. Now, this is something we need to. So there are certain things we need to, like a polarity. So it's a polarity. So support is on one end, and resistance is one end. Um, Price is on end, and then the volume is on one end. So we there's a polarity principle, right? So same way in our thinking, we are trained. Our brain is trained to work in just one way. So uh, maybe so I give you some hints and see which way you tilt. So matching versus mismatching. So there's something called matching versus mismatching, and how it relates to uh, price and volume analysis. It will clear to you by the end of this teaching. So how your brain works with and compare data. So think about it. If there's 5 pieces of data there, then how you evaluate that data. So think about that. There are 5 pieces of 5 pieces of information there, and then are you matching or mismatching? So think about that. What relationship your brain adopts towards information. So do you match or mismatch? So these are the questions we need to ask and then do the research. So I'm constantly, so these questions are in front of me all the time. I have tons of this kind of information. I'm reading and preparing and working on it, and then I go and do the research. So not only the technical side of it, of the trading and the, just so it's not going to work if you're just focusing on one side. You're just focusing on 20% or 25% of your trading. You're ignoring 75% or 80% of the thing which you need to work on to become a better person in whatever you're doing, including the trading. Now, the third question is, do you approach things seeking to match what you already know? So this is the bias. This one is a big thing. We as a human, silly human, we try to match the thing what we already know. So we already know, or we are seeking the answer, and we are going to look for the same, some kind of a confirmation. So this is a confirmation bias. So we want this stock to go to the 100 level, and it's going the other way. So we are going to read the market, the news and articles which tells us that is going 100. We are looking for all those information which will confirm our desire, what we are looking for. We are looking for someone to say, hey, um, uh, this is going 100. So it's like that. When I was little, we in our home, so there was a table, and above the table was a socket, and that socket, the electric socket, was you put the your finger and then you get the shock and you fly, uh, so that kind of socket. And my mother told me, hey, never put your finger in this socket. So I did not listen, and I did. And I put my finger inside and I flew from the table all the way to the floor. The floor was a concrete floor, and my mom woke up. She was having a nap. She woke up, and I'm crying, and I'm so my the way I used to get console is when my mother tells me that bad thing happened, don't cry. So that time my mother did not tell me bad thing happened, don't cry, my son. So I cry, and I'm waiting for my mom to say that the bad thing happened, don't cry, and I wanted her to pick me up. So I remember this incident. So it took her a while to come and tell me bad thing happened and don't cry. So she was very upset at me that I put my fingers in that socket, and it was like AC, DC, something like that. So this is what we cry, and then we go to look for the thing which can console us. So think about that. So the bad thing happened, don't cry. So are you like that person? So do you approach things seeking to mismatch? So if you are in the trade, then you're looking for things which is contradicting, which is not matching to what you're looking for. A dominant role in determining your overall style of thinking and reasoning. So matching and mismatching. So there are a few slides I want to show you or uh, tell you, and then you go and do the research. So there's something called correlation versus exception, and there is something called correlation versus causation. So there is another presentation. I have another coaching session I did about 3-4 weeks ago. I'll teach again. It's about correlation versus causation. So that's a different topic, correlation versus causation. So sometimes we think this thing is correlated. It's actually causing it, not correlated. But here we are talking about correlation versus exceptions. So in correlation, we are matching, we are searching for correlation. So if this thing happens, then this thing is also happening because they are correlated. And then there is something called mismatching, searching for exceptions. So mismatching, searching for exceptions. So there are 5 things on this. In the room, there is one which is not matching. So one which is not matching, and we are not paying attention. The four are matching, and the way that 5th one is laying there is not matching the other 4. So if we are not trained to identify the mismatch, we miss out. So same concept applying in the trading also. So searching for exceptions, or you're searching for correlation. Now we need to ask these, let's say I give you example, we need to ask the questions to ourselves. What do you pay attention to first when you walk into a room? So if you walk into a room, let's say you visit a friend and you walk into the room, what do you pay attention to first when you walk into a room? So think about that. So yesterday, I give you example. So yesterday, there is a house which has beautiful trees. Those trees are just amazing trees. And so I searched for the trees, and I could not find the trees on the internet. So I stopped by and I knocked at the door, and the gentleman opened the door, and I asked him what kind of tree he has, and he said he doesn't know, and if I can find out, then let him know. He has been living here for 16 years, etc. And that is a Spanish style, very beautiful home. So he invited me. He said, "Hey, you want to see my house?" I said, "Sure." So I went inside, and I noticed, it's like I am in a kind of 1920s home, and there were things in that kind of era, and he was proudly explaining to me that this is from this era, this is one from this era. His TV was playing. Fox News. He had some war certificate, and he was very proud to show me his whole house. His wife, he said, "Hey, I'm showing you this house, and I hope my wife doesn't come. She is out. I hope she doesn't like me to invite anyone to show the house, and I'm proud of my house." I said, "Yes, your house is very, 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 very unique, and it is indeed beautiful home." So if I walk into the room, what I notice? So I noticed different things. So I don't want to go into that, but think about it. The 4 different pans of colors. So let's say 4 different pans of same colors. They are there on the table, and 3 are lined up and 1 in a different position. Are you noticing that there are 4 pans and 3 lined up? You're looking at them, that the pans are lined up, or you are noticing that 1 pan is a different position. So do you notice the same color? Are they the same color? Is your eye trained that it's the same color, or you are noticing? So the 4 pans are red color, let's say, and 1 pan is there and not lined up. So are you noticing the color? They are all same 4, or are we noticing that 1 pan is not lined up? So that 1 pan is not lined up. Maybe you are trained to find the one which is not lined up, or maybe you're trained to look for that the 4 pans are the same color. So think about that. So sometimes when you go inside the house and you see the painting and it's not hung properly, so it's not straight, I have a tendency that I immediately say, "Oh, man, this painting is so good, and look at it." This person is not noticing that the painting is tilted, little tilted. So I'm thinking in that terms. So think about that. And the same way, the same principle you can apply in trading. So for to detect the anomalies and validations and what you are overlooking. So what you're overlooking in the trading. Matching for sameness. So match current experience with the previous experience. So this is the concept. We match, we so the intuition. So intuitive traders, they match their current experience with the previous experience, and then they take the decision. So these are the intuitive traders. They don't go by the like a checklist or rules, etc. They go with the with their experience. So match the current experience with the previous experience. So I tell you few my examples. So one day I was driving in my neighborhood, and so there are homes for sale. So they are there. They're not extraordinary, but one home says for sale sign. So it just clicked that this home is something different. So I went next day, and they had an open house, and I went, and it was so good. And I said, okay, maybe I need to do some research, and I will give my offer. But so the Monday came, and they already had the offer, and it's gone. So so based on, um, I did not have to do the research or ask for opinion. I knew by looking at it that this house is unique and it's right. Same way, this house where I'm telling you about the tree. So when I was walking out, I asked him, "Hey, if you ever plan to sell the house, please call me. Here's my number." And he said, "Wow, me and my wife, we are thinking about selling this house because this house is so big, and we are retired, and we don't need this house, and we need to move somewhere else." So I said, "Well, you have a buyer. If you want to sell, you know, so please call me. I'm your neighbor." So I gave him my number, etc. So just by looking at it, and I got the feeling that this house is really unique. And I asked him, "Are you planning to sell this house?" Because they're a retired person and are living there for 15 years, no kids, etc. And I can see the big, huge house. He is sitting in one corner watching his TV, and he showed me his wife's office is on the other side. So I said, "Oh goodness, this big mansion, and they are just what they are doing in one end and the other end." So no need to go dig deep. So intuition is match current experience with the previous experience and make the decision. So looking for similarities and the pattern. So you identify a pattern and match it, because you have seen so many patterns before, and you don't need to you make the decision right away. You go with your intuition. You don't need to go for the checklist and rules and everything. If you go through the checklist and rules, that it could be late, or you may get the contradictory opinion if you start asking your friend. So I tell you, I asked my friend, and then he gave me an answer, and I hesitated, and it's gone. The very next Monday, that house is gone. So think about that. Now, mismatching for differences. So there are people who mismatch for differences. They are looking for things which differ. So the thing which differ is the four pans lying up, and one pan is not lined, and four pans are the color. So this is where the anomaly is. So anomaly is, and it's the way you need to dissect any trade, and also the volume. So the people who mismatch for differences, they first notice things that differ. They notice the picture that is not hung straight. So they are the person who, when they visit the house or the any place, they see, oh, this picture is not hung straight. So um, I notice I am that kind of person. I notice the thing which not lined up properly, and so that's me. So somehow I develop like that. So who are these people? They like re-engineering. They like innovation. They like new things. They look for different things. So ask yourself: do you look for a match? How are you evaluating? Do you you match or mismatch? So there are people also matching this mismatching. So first they match, then mismatch. So they look. They have the certain way of doing the analysis. They first match and figure it out what matching, and then look for the things which are not matching. So first they look for all the things which matching, and then not mismatching. So maybe you're evaluating a trade and you're saying, okay, all these things are lined up, but this is not lining up. So the dog did not bark. So think about that. First match, then mismatch. So first sort for similarities, and then sort for differences. So sort for similarities, and then sort for differences, and then come up with your conclusion, what you are trying to achieve. So just knowing that you may be matching and then mismatching, and then sorting for similarities and sorting for differences. So this is one side of the coin: matching then mismatch. And then there are person who mismatch and then match. So they look for the differences first, and then they look for sort for the similarities. So first mismatch, and then match. So first they sort for differences and then they sort for similarities. So think about this. So maybe you're seeing something and something is not looking right, but there are a lot of things which are looking. So you're looking for immediately. You're looking for that this is not looking right. But then you start looking for things which are similar. So maybe you will change your mind based on the similarities take more weight than the differences. So you say, okay, I ignore that difference. So now knowing all that, so we go back to the price and volume analysis. So price and volume analysis is universal. So it means it needs to be applied in all areas of trading: stocks, options, forex, futures. Analysis of price along with volume is a supreme way of trading. So supreme way of trading is analysis of price along with volume is a supreme way of trading. So sometimes we know what is right and we still do the thing wrong. So we know the thing is, I need to pay attention to the volume, but we don't do it. So maybe you put a sticky note, look at the volume. Volume creates a strong support and resistance. So what is actually volume? Is the number of transactions, the number of shares or number of units, number of contracts. So they transacted at different price at the different time interval. So if the more volume is there at a certain price range, that price range has a meaning. So it's like, the traffic, there's a traffic signal with a lot of cars, and there's a traffic signal in just a few cars. So some traffic signals make more meaning than the traffic signal where there's no car, just a light there, red light, stop. So think about that. Volume creates a strong support and resistance. So what is volume? Volume is the number of transactions. Who is creating the transaction? So it's not only not the transaction, the number of shares plus the number of transactions happening. So think about this: the transactions and okay, go. I'm teaching. My son comes and asks questions. So volume creates, and he's just a 5-year-old, and he's asking question which is for him is very important. And he asked me when I'm gonna pick mama, and so for him this is very important, that when I'm going to pick mama. He doesn't know. I told him, hey, don't come to my room. I'm teaching. So think about that. So volume creates a strong support and resistance. So the number of shares, number of contracts, plus the number of transactions. So pay attention to the number of transactions. How long it took for that price to stay at that price. What's the time, and then which range? What is the range? So there could be a high volume at the top of the trend. So this is called volume climax, and there could be a high volume at the bottom of the trend. So volume climax. So we need to understand if this is a volume is trending or volume has a climax. So ideally, the volume bar should gradually build up. It's not like like a tower. There's a big tower of volume, and then there's nothing. So think about that. So we need to train ourselves to look at the bar, which are gradually moving up or gradually moving down. Compare and then over, not looking at the tower. So big 100-story tower, a volume spike, and then there is nothing there. So that could be just a spike for the whole day. The spike was there, and then there's nothing happened after that. So pay attention to that. A high volume at the top of the trend, maybe that's the end of the trend. After that, there's no buyer left. Or high volume at the bottom of the trend, after that there's no seller left. So no seller left, no buyer left. So this is again a detailed topic: volume climax. Also, what time interval you have. Do you pay attention to multiple time frames? So I have these time frame on my chart, and I flip it. So I have these are the time intervals, plus I so segment it into different category. So you can call it like a minor or a smaller time frame, and a mid time frame, and a longer term time frame. So for me, the longer term time frames, so think about this. So on your platform, you need to have a monthly time frame, weekly, day, and a 195 minutes. And the reason 195, you can say, or you can put any other time frame, but I put 195 because there are 390 minutes in a day. So in a trading day. So if there are 390 minutes in a day, I just divide it into 2 and 195. So this 195 day, week, and month is one time frame segment. So it's a long term. So this is a long term. I look at it, what is going on so everything starts on a day time frame for me, swing, because I'm a swing trader. So or doesn't matter, even if you're a long-term trader or a short-term trader, everything starts from the day chart, because this is where your day starts. So if you come to your office to trade 6:30 a.m. Pacific, that's where the day starts. So how can you start your day on let's say 65-minute chart? So everything starts from the day. You look at a day and then you can lean. So a weekly chart and a monthly chart is you leaning towards to see what else is going on. So just to look at it, and I will explain more later why weekly and monthly important. So then 195 minutes. So I go on a 195. It's a half day of the chart, and it has a continuation. So it's the 5 days. So there are 4 weeks. The week comprise a month, and there are 5 days. 5 day comprise a week, so there are five. And then half of day is 195 minutes, and then 130 is divided into 390, and then 65 is also divided into 390, and 13 is also divided into 390. And then there are some symbols which you can look at the tick chart. So tick chart is very low level, and not all the for me not all stocks you can read because of lack of volume and the number of transactions. You cannot read those charts on a tick chart. So I have a 5-minute chart. So 5-minute chart is missing here. So I have another one which is 5 minutes. So day, month, week, day, and 195 is one time interval, and then another one 195. So for continuation, 195, 130, and 65 is one segment, and then 65, 13, and 5-minute chart or a tick chart is on another workspace. So you need to analyze the volume on all these time frames, especially if you're looking at intraday, the volume should be building up, and the day to analyze the volume in a day is a very late entry for swing trading. It's very late for the day. Day has not closed, so you don't know. So you have to analyze the volume on these time frames, 13, 65, these intraday time frame. So you have to analyze on the intraday time frame. So also, if you are if you have a proper system and you are getting your entries on an intraday level, then it should be such that the intraday level is so let's say you get in at 65-minute basis interval. So if you're getting it at 65 interval, so you're getting it very early, 1 hour chart basis. So you have a very head start compared to others who are waiting for higher time frame to give them confirmation. So you're initiating a position at the intraday time interval, let's say 65 minutes. Then when the trade is building up and your further time frame is giving you confirmation, then you are adding it, because it's a higher time frame is giving you the confirmation that what you decided on a lower time frame, now it's showing at the 195 minute. Now it's showing at the day completed, and it shows on a day chart that this is completed. When a day building up, like today is Wednesday, so Monday, Tuesday, Wednesday, the week is forming. So now you midweek you start to look at it's a weekly is confirmation. So it will give you need to stay in the trade longer. And then if you are a long-term trader, the week will build into a month. So that trade is on a monthly basis for a long-term hold. So your strategy would be that it's a very trending strong stock, and now you're looking for an entry on a lower level time frame. So maybe you will look for the entry on a day time frame. You wouldn't look for entry here on this time frame. It's too narrow. If you can do that, you have a monthly signal, and then you're looking at the day for entry. You have decided on a daily basis that okay, I need to go in, and then you're just timing your entry on a lower level time frame if you can do. So this is the multiple time frame we need to have in order to execute our trade and in properly. exits and entries, and scaling in and scaling out, risk control, reducing the exposure, reducing the number of the points we will lose when the trade goes against us. It will increase the number of shares we can buy, number of contracts we can buy, because we are reducing all that. So these multiple time frame play a role in your trading. So volume and type of trading can be applied to any kind of trading. It should scalping, day trading, swing trading, long-term trading. So it is applied in all kinds of trading. So volume is supreme. Volume needs to be paid attention to. And remember, all volume is relative. So if some stocks for the volume of 200,000 is too much, because they usually trade at 20,000, 30,000 volume, and now they're trading at 200,000. So it's too much. 200,000 is too much. But for Apple, 200,000 is not. It's nothing. The moment it opens, the market opens, and 200,000 shares is there. It goes in the millions. So it goes in millions. So volume is a powerful indicator. Price without volume is meaningless. So if the price, if something is bought at 10 and sold at 20, so and then there is only one share or 100 shares, then what? Who? So somebody just bought it 100 shares. So this thing happened in a pre-market or aftermarket, 100, only 100 shares, and then we talk about this stock is moving up or moving down, but look at the volume, it's not there. And the time is the key component. So not only the volume and the price, but the time. So time is also important. So ask yourself, how many times? So how many times? So if something bumped up at a certain price level multiple times with the is above average volume, that is playing more role than if something is hitting something some price level only the first time, even though the volume is high. So the first time, which one is more relevant, the first time only one time, or it has hit the same level 5 times? So that is very important. If it hit the 5 times, you need to rate that resistance or support higher level compared to if it has hit only one time or 2 times. So the number of time it hit, the more value it is. Same thing for any price level, the trend. So if the trend line, you draw the trend line, if it hits only 3 times, it's meaningful compared, but it's not as meaningful as when you're looking at the 5 times. So you tighten your criteria that I want to look at the trend line broken after 5 times, the stock maintain that trend line 5 times, and now it's breaking. So time is the key component. Another one, when you dissect the volume, so when you open the candle, let's say it's like dissecting the frog. So you open any 30-minute volume bar, and then you see where most of the time, which price range the stock traded the most. So, and for how long? So at what? So if you are analyzing a segment from let's say 7 a.m. to 7:30 a.m. So what's the volume and at what price range? So the price range, and then how long the stock traded in that price range. So the longer the stock traded in that price range, and the more volume it has in that price range, and from which direction the stock was trading when it hit that price range, have meaning. So if after trading in that range for a long time, like 45 minutes, it traded in one time range and a lot of volume is built. So the upper range is the resistance and the lower range is the lower price range is the support. So if it breaks the support, it's meaningful, and if it breaks the resistance, it's meaningful. So you pay attention to that. You draw the support and resistance line. When it breaks, you should get the alert. When it gets the alert, and if your strategy is to add more to the position, you add more to the position, because it after 40 minutes gone by, this much volume, this is the range, and now finally it's breaking it. So the stock do that all day long. So you add to the position. So we start very little, and then we add it, and then add it, and make become that position become like a green. So initially, if we are analyzing it just here, if we are analyzing it as 65-minute chart, so it's just showing something. So things are there, not everything is matching. So you say, okay, I'm going to buy 100 shares. So you push the button, buy 100 shares. So you bought 100 shares. Now you set the range and you say, okay, if this thing goes up, and I will see. So after 30 minutes, it's crossing this, and then you analyze it, and then you say, okay, it spent this much time, and now it's really crossing this. So my analysis is correct. It's telling me. So I go buy another 100 shares. So I'm giving you an example. I say, okay, I don't mind buying at the little higher price. So I know my price, and it's showing my average cost. My average cost is still, even if I buy 100 after um, at the higher price, my average cost is still high. And then I'm looking for more confirmation down the road. So down the road is this 130, 195 day. So I'm adding more. My average cost is um, it's going up because I'm buying more. I'm averaging up, but because of the distance I have and because of the so many confirmation I'm getting, so I rather buy something of the good quality apples or mangoes than look for something. So why bother? Why bother? um selling something which you have it now, you have it in your control, so hold it for a while, and instead of selling, try to build your position into that winner trade, because if you have 15 position open, there are only 3 and 4 which are really fat, real fat, and others are, because what happened when you entered in the 65-minute and you bought 100 and then it didn't do anything, it just stayed there. So 100 is either showing you 50 shares profit or 50 share loss. So you just say, let it go, close it. You don't even bother with 50 here. Okay, close this one, close it. This one is the one I need to pay attention to. This is the one which is moving. So have a system which tells you multiple confirmation as the trade goes in your favor. You keep getting multiple confirmation and you have a plan to add. So you scale in and build a fast position, because that is the position which is sometimes you get this unlucky and you hold into that position, earnings, etc. So just pay attention to all this and then leave it, you know, overall you will be fine. So time is the key component. Now here is a candle. So I'm sure you know all about the candle, but maybe out of all of you, maybe there is one person who doesn't know. So I'm just explaining. So this is called a spread because this is the open and this is the close. So another thing I will explain to you. So this is the lower wick because the lower side, and this is the upper wick. So these wicks, pay attention to the wick. They play a crucial role. They tell you the story. Pay attention. Now this candle, you see it's white color, and the reason why it's white, and I'm telling you why this is a bullish candle, because I'm giving a meaning to this candle, that this candle, because it's white, I I call it bullish candle. But if you go in China, so sometimes there was one time I saw on the screen, and it says Chinese market were all very bullish, and this show bunch of like symbols, and they're all red. So I said, what? So then I figured, oh yeah, the red is a symbol of whatever happiness and good luck. So they turn the color of the candle into red. So you can color it red also and still consider it bullish as long as you know what color you're giving. So the white candle is, we are giving a color, a meaning, white, we are giving a meaning to the white color that it is bullish. So this is the spread. So spread is between the open and the close. So we understand that. And it's the candle is bullish because the open is lower than the close, or close is higher than open. So now we know that this is bullish. Now we don't know the price, right? We don't know the price. What is the price? Is it open at 100 and close at 110, or open at 100 and close at 120? So we don't know what is the meaning of this spread. So it's all relative. It could be a $10 open and $10.20 close. It's only 20 cents, but we are giving a meaning that this is a wide candle, long candle, bullish candle, and is a bullish everything here is bullish. Now this is typically in a day. If you plot the all the transactions, um, if you plot all the transactions, let's say you are reading the transactions and you're plotting it. I will show you some other day another chart, a bunch of dots there. So there are a bunch of dots because all the transactions. If you take a computer printout of all the transactions, let's say 100 shares at this price, 200 at this price, 300 at this price, it's like a bunch of dots. It's just bunch of dots. So bunch of dots there, and when the and they are moving in this pattern. So this is the opening price, and then it goes and makes some low, and then it goes up, and then it closes here, and this is a positive because this close is higher than this, so it creates this sine wave, and we call it bullish. So this is the way the bunch of thing. So this, by looking at the price action, we don't know what else has happened if we don't analyze based on the time and based on the volume. So we don't know where most of the day of the time or during the day where the price took place and at what volume. So I read this, there is nothing new under the sun. So everything is all the stock, they are just doing this on a day chart, on a multiple time frame, on a 30-minute chart, 15-minute chart. They are just doing this up and down, and there's a volume bar you can plot, the time bar you can plot, the time you can plot, the volume you can plot on the vertical axis, and the time you can plot on the horizontal axis. So you can do all that. And then if you plot the volume on a vertical axis, then you would know which range. So you can create a volume profile, and you would know at what price where the volume was. So you can plot the volume horizontally also. So this is the sine wave price action. Now this is another way of looking at it, which is a downtrend cycle. So inside and outside. So this is a typical. Sometimes the stock is under pressure and it's selling, is going down. So this is where the stock opened and it started to move down. So it's coming down, 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 and then it makes a low. So here is the selling pressure, and that is why the stock did this, right? Because it has a selling pressure. So there are more sellers than the buyer. So it's just coming down. The buyers cannot um, absorb all the selling. That's why the price is lowered. So there is more selling pressure than the demand. So there's more less demand and more supply. So when the supply is more, demand is low, the stock drifts lower, and then eventually it comes into some kind of a low. It creates a low, and then it starts to move up. It's move, 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 and the buying pressure builds up, and then it goes up and close at certain price. So um, so now if the stock has gone down with this much, there's a spread from open to low, and then it goes up. So there must be something, some power here to bring the price back to the same price at the close price, open price. So the net change is zero, and it happens. So think about it. It's the sentiment has changed. The sentiment was negative here, and the sentiment is positive here. So a lot of buying power took place. The more distance the stock or that market has between open and low, the more buying pressure it needs to bring back to the close price, because there's a lot of it's continuous buying needs to happen. So this is what we are looking. We are looking from outside this price action, but we need to dig deeper. If you're looking at the day chart, this is what you're seeing. You're seeing open here, low here, and then the buying came and closed. But in order to look at the real price action, you have to pay attention to the intraday time frame. So if it's a day chart, you have to open your intraday chart. If it's the day chart is not telling you anything. It's just telling you open, low, high, and close. That's it. And by the time net change is zero. So, but you have to dig deep intraday. So when you open your intraday time frame workspace, you would know from when to when, um, and during what time of the day, what was the volume when this selling pressure was going on and the price made the low. On this side, what time of the day and at what volume this buying occurred. So it looked like it went up, but intraday you would know. If you look at the intraday bar, you would know where the volume bars picked up and what time interval and what time of the day, and when it was moving up or it was coming down, where in which price range the stock just got stuck. Because there has to be, just like when it was coming down, it just, unless there was a tremendous selling pressure and it just tanked from open and then and went to low, there must be some halt here, some kind of a twist and turn. So some twist and turn happened during this journey from open to low. So there was a twist and turn. So that twist and turn is only you can see on an intraday time frame. So let's say 30 minutes. So you see the 30-minute time frame, and then you plot the bars of volume, and then you can see that at this time frame, at this price, there was a volume. So that if when the stock was coming down and it stopped going down at certain price level. So let's say this is 100. So just think about it. This is 100 and this is 90. So from 100 to 90, the stock was fell. But when it was traveling between when it was trading between 95 and 96, it halted its downward journey. It halted for a while. It for an hour. It traded between 95 and 96 range. So it traded between 95 and 96, and the volume compared to all other areas, all other price levels, the volume between 95 and 96 was the highest. So now, so there was a battle going on between 95 and 96, because somebody was selling and somebody was buying, and that's why there was this tremendous volume, and the stock did not want to go down, and it did not go down for, let's say, for 2 hours. So there was a 2 hour battle happened between the buyers and sellers between 95 and 96. It is a huge volume. So think about it. All the buyers are there at 95, a lot of buyers, because they it's like soldiers. They came and defended their territory at 95. They bought it, but later the selling, some negative news comes, and then everybody started to sell. So those who did not sell, they sell, and more sellers come in, and the buyers who were there at 95, they could not hold the territory, and either they sold or they still holding it. So think about it, they sold or they're still holding it at 95. Now it went to 90. So it went to 90 and now it's moving up. So think about it, when it started to move, those, so it will not, unless there's tremendous buying pressure and a very highly bullish news, the stock just kept going. It will not go like this. It will, sometime it happen intraday reversal, but it will stop at 95 and 96 in the middle here, because all these 95 96 guys, they will start to sell, because they just want to get out at break even. So they want to get out break even. They may even get out earlier when they spot the reversal here. So they reduce their average cost, because they bought at 95 96 here. They bought when they spot the reversal, they bought some here. So their average cost is lower. It's not 95 96. It could be 93 92, because they bought some here. So that's why there's a resistance here at 95 96. And then so you if you're paying attention to only this 95 96 resistance, so that's good. On the way up, you will see the price will stop here and the battle will go on, and sometimes the battle goes on and then the further decline occurs, because not the buyers who are here, they just sold fast. Their selling program kicks in and they sell, and then there's nobody left to buy, so the stock just tanked. So but if they average it down here somewhere, their average cost is lower than 95 96, so they will start selling earlier. So that's why you see temporary, you think that the stock will hit 95 96 and then I will get out because this is the resistance level. No, because they average down here, it will, maybe it will reverse at 93 94. So that's why if you are initiating a position somewhere here in intraday level, somewhere here intraday level, you watch the volume. What is the volume going on, and where you anticipate? So you have to understand that the selling pressure can come in in earlier than what you were anticipating, because you're anticipating this will come here, and then you set the target, sell target here, and you will make money. So you have this strategy, or you want to add. So somewhere here the stock will stop, and now you start watching what's the volume and how many hours gone by. There's a battle going on, so you understand that when it conquered, then you initiate a little bit more. And then another one is here. So another one is not, you're not buying at this level. So if you're buying at this level, you missed out all this, because the battle was here in this level. This is a clear territory. So this upper side is a clear territory. There's not much. This whole section between the open and low is the resistance. And so this is the reason where the sellers are. So we know that with open and low, this is where all the sellers reside, because that's why the stock sold. But on the way up, the sellers are being taken out by the buyers. So it's like in stages. So the army is retreating. So army is retreating, and it's decimating. So think about it, all that they are decimating all the sellers in between. So in this price range, there will be a battle. And so you need to have a strategy. When this crosses, you add more to the position here, because this is you can add here or the next day, but you need to know that this is where the battle happened, and I need to monitor this and add more. So you initiate a little bit here. If it doesn't go up and it tanks, you are out. But if it conquers here, then you add more. Then you say, okay, I will see what happens next. So the next day, a price action will tell you that this downtrend is over and the buying has begun. The sentiment has changed. This is where the most of the money is made when you trade like that, not just buying at the top. So now, so what we talked about, what is revealed? So complete reversal in market sentiment. When you saw that, is a complete reversal in a market sentiment. Selling pressure overwhelmed by buying pressure. In the beginning, the first half, the selling pressure overwhelmed by buying pressure. Sentiment on the close of the bar is bullish. So always that whatever time interval you're looking at, the time 30 minutes, 60 minutes, whatever time interval, then you ask yourself, what is this? Where is the what kind of a sentiment it is? What kind of a this bar is telling me? Is it a bullish bar or a bearish bar? So you start drawing the line for the resistance and the support. So always have a range. So identify the range, that this is what you're looking for, set the alerts for that range, and then you can go about and do other things. So I can monitor simultaneously. I'm trained myself. I can monitor 20-30 charts stock at the same time. So um, I have 3 computers, multiple monitors, and I'm simultaneously doing all that. And and it's also very important that you have so we are going on other topic. You have a trading buddy. So trading buddy, you're speaking. You're not looking at him. You just speaking and he's speaking to you. You're just speaking and telling what to do. So on one hand, you're looking at all that and you're telling someone to help you on the other side. It's like your tag team. So you're doing things. So have a trading buddy is very important. So sentiment on the, so have him on the Skype, have him on some other audio, have another iPad. So I have an iPad just for this, for just to speak. Have a WhatsApp. I'm talking on the Skype. And other like direct phone line. And so I'm not just telling what to do, sharing screen and show me this. Now I'm doing something, show me that. I'm doing something, show me this. How does it looking? Share screen. So on just one screen sharing on the iPad, I'm talking. And on different monitors, I'm turning my chart so I can watch 20-30 symbols at the same time, analyzing all this. So you have to train yourself like that. So sentiment on the close of the bar is bullish. The picture is not complete because the volume is missing. So here, the picture is not complete because the volume is missing. So you have to look at the volume. You have to look at the volume, at what price level the volume occurred, and what time frame. So you have to analyze it during what price range most of the volume occurred. So then you know where the battle is, both sides, on this side and on this side. So after the low is made, where the most of the volume occurred, during the selling pressure, where the volume occurred. So you can, and how much time was spent. So time and the volume and what's the range. Once you know that, then the picture is comes out clear. And pay attention to the lower wick and the higher wick. So in this case, what we saw is a zero spread. So what we need to look, volume inside of the candle is unknown right now on that chart. But I said inside of the candle, meaning, you open the, take the frog, dissect it, and see the thing. So you can look at the what time interval, during what time and what price range, most of the volume was there. Volume outside of the candle unknown. So in this chart, what I showed you, there's no volume. So you have to dissect it into detail. So picture and relationship. So big picture, volume and price relationship. So always, um, um, so big picture is volume and price, and detailed picture is when you include the time. So in other words, there are three components to your trading: price, volume, and time. So we don't, so time is very important, critical. So how much time the stock was there, the longer it holds a trade in a certain range and then breaks out or break down, the more meaningful it is. The longer it spends, the stock maintain the time, the more meaningful it has become, the volume and the price. Now, if we reverse it, uptrend cycle inside and outside, when we reverse it, this is what we see. The open is here, the high is here, and then it just made a high, and then it tanked and closed. So selling pressure here. So when it was going up, this symbol was going up, it must have halted unless it's super crazy and it went up. So it must have done some twist and turn in certain price interval. So certain price level with the volume. So see where it spent most of the time and what time zone and with what volume. So figure that out. Once we figure that out, on the way when the stock is coming down, it will these buyers on the way down. These buyers will come here to defend the position because they bought it. But if the sellers are more, then they will take over the buyers. So when they take over the buyers, those buyers, so there are buyers here. So think about it. There are buyers here. That's why the stock is. There are buyers here, 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 here. So these buyers, they when the stock is doing this, they're looking at this area. So they are looking at this area. They say, okay, this was a kind of resistance. So this was a resistance when the stock was moving up. This was this, and it halted here for a while. So a lot of time spent like 2 hours, and there was huge volume here, and a lot of time was spent. So this is was a resistance, and then finally it broke. So when it broke, it created a support. So this is where the support is. So in other words, um, so we tend to analyze the support by looking at the price reaction from the low side, which is not only one way of looking at it. The support is where the resistance was, and this was broken. So when it's broken, the resistance has become into support. So now think about it, the resistance has turned into support. So polarity principle. So the resistance is not just support is not when the price react, go up. The support is also when the resistance is broken. So this was a resistance and it went up. So all the buyers are here, and there are a lot of buyers here. So when the stock is coming down, these the traders who bought it here, they are looking for help here in this side. They're saying, okay, I have help here because there's a lot of price action. So this is my support. And the seller, they also know that this is where we will meet the buyers. We will meet some pressure here, some power here. So but when they take over, so all these buyers, those who bought here at this level above, they are all losing money when it when in this zone. The buyer who bought at the top, he is losing right away. The buyer who bought here, he start to lose somewhere here. And then a lot of buyers, they bought here, so they start to lose money here. If they did not do something, they are losing here. So once this selling pressure builds up and all these buyers, they have the hope, they will be getting out. They have nothing left. So all the selling pressure will build, and some of the buyers who were bought it here, they will turn into seller. So they will turn into seller after selling out. Because they bought it here and it's not defending. They defended, but they're not working out. So they sell. There are more sellers here, and then there will be some other traders on the side who are doing nothing, they will come and join the side which wins. So if the side who's selling it and it wins, they will join it. So there's a lot of things going on behind: buy, sell, buy and sell, buy and sell. So the price open and close. So the net result is zero. So now we need to, this chart is not telling us where is the most of the price happen, what time interval, and where's the volume, which side has the volume and at what price zone. So analyze the volume. So if we if we take this chart, open and close this chart is transformed into this chart like a T. So it's like a T. So that was one way of looking at it, and this is another way of looking at it, which is a T. So selling pressure is here, buying pressure is here. So it's like a hammer. You can say a T or whatever you can call it. This is the way it looks like when you look at the bar. When you look at the bar on your chart, this is the way it's looking at it. So the net result is zero. So this on this side is the selling pressure, this side is the buying pressure. This the buyers reside in this side of the zone and the sellers are residing here, and then you analyze which price zone, where was the volume. The other chart looks like this: upper uptrend to downtrend. So the open is here and this is the high. So this was all the buyers and this is the high after high, selling. So selling pressure is here and the net result is close. So it is this shape is a bearish trade, and bearish shape, bearish sentiment is also called, they call it gravestone. You can call it anything, but this is the way the bar looks like when it's bearish. So when it's bearish, this looks like this. Now what happened next after the formation of this bar on any chart, any time interval, tells you the story. If it holds this level and the stock trades in this level, then there is a hope. If the stock trades below, then there is no hope. The stock will come down further. So this is where the stock will fight this level, this price. So art or science of price and volume analysis and an art. So it's all art. You have, and the volume analysis is subjective, so pay attention. You can program it, you can make it scientific, looking for this price, looking for this volume, looking, this is the average volume over this time period. So you can make it science, mathematical. So if you have the capacity to program, you can program it and make the volume analysis based on the mathematical formulas. Market does the mopping. So mopping goes on. The stock just does this thing, create support and resistance. So they are looking for weekend and etc. And they just come with the buying pressure. So the market, the meaning the big boys, they have the money to come and hold a certain territory. So we need to analyze that territory, where they are coming and what price level. So pay attention, adopt the mental state of being patient. So be patient, go slow. Market shakes off weekend. When volume is detected, be patient. So be patient when volume is building up, and so it needs to build up gradually, not a certain spike. So if you're looking for a spike in volume on a 2-minute chart or 1-minute chart, that is a garbage, that is a noise. So don't pay attention to the volume spike alert. The volume is spiking, that is a garbage. So volume can spike and then nothing happens, and then so gradual, everything gradual building. So be systematic. Stock the trade, create a form of risk control, read the tape, read the price level, draw the support and resistance line. So learn to draw the support and resistance line on an intraday chart. You can draw the support and resistance on a daily chart, that's one time, but actual support and resistance evaluation is at the intraday level. So evaluate the landscape and then ask yourself, is the buyer gone and the sellers are here, or the sellers gone, the buyers are here? So there could be some V-shaped rallies and reversals do occur, but they are rare. So V-shaped rally, sometimes they occur intraday level. So and then we get trapped in on the other side. So if that is happening, be aware of. So there are dark pools. We know dark pools. You can read about the dark pool. They're invisible orders. So what they are doing in the big transactions that are happening in the dark pools, and we are not aware of. If you can read level 2 market depth, you do that. I don't do that, but you can if you want. High frequency trading going on. There's 100 shares. If you look at the tape, you see a lot of 100. So everybody is buying 100 shares. So so imagine if you have a program to buy 1 million shares. So would you buy? You can go into the dark pool and buy 1 million shares. Somebody will sell you. You wouldn't even see it, or you unleash your buy program and you're buying 100. That's why we see 100, lot of 100 shares somewhere in 1,000, 2,000, then 100. So it's just a program executing shares in 100. There could be data imperfection, data discrepancy. So what is your source? So if you identify there is something going on with the price, so you detect that this doesn't look right. So you must have multiple source to verify. So multiple data source. So if you just rely on one data source of your broker, uh, you may get caught. So so have a multiple. When in doubt, you verify the price on another platform. So you have to have a multiple sources of data. And think about it. If you're paying for the data zero price, then you're getting that kind of a data, zero price data. If you're delayed data, not good data, so think about that. Fake bids are occurring, cancel orders, all that tricks are going on. So they have the speed of their infrastructure. They reside next to the exchange. They have a supercomputer. They are doing all that. They are trading. You're trading against them. So you're trading against them, or you're trading in along with them. So if you they are a high frequency trader. They are making money in 1 cent, 2 cents. So you are not unless you are that kind of trader. You're not that kind of you're not that kind of trader where you buy and sell and you front run. So if you have that capacity, you good. Otherwise, don't haggle for 5 cents, 10 cents. If you see the chart and it's lining up, just don't, just buy something and move on. Don't haggle for 2 cents, 3 cents. So I don't do that. I don't know. It doesn't make me any difference if I buy 5 cents more or 5 cents less, because I will miss out if I try to time 5 cents low. No, I don't do that. So if I see something, yeah, I can do my analysis on data, but then I don't 5 cents, 2 cents, or unless there's a spread between the bid and the ask. So I'm not touching that. If there's a high spread, and then I know that this is something wrong. If I'm buying something at 100 and the bid is 99.50, I'm going to lose 50 cents right away. But nobody is going to buy back from me 99 because immediately I buy at 99, if I sell, I have to sell at 89.50. So there are a lot of stocks, especially big price, they have a huge spread. So you immediately lose $2. There's there's spread of $2. So you don't want to do that. So you can buy, shave this, buy, do the split or etc. So all can bid plus one or things like that. So you can do that, or you just simply um, put your limit order and move on. So your data feeds are complex. So think about it, your data feed complex. Have a multiple sources of data, because you analyzing something on one source may not be valid. And if you're looking at the bar based on the data and volume, you may be reading the wrong data. And if you are a chart pattern kind of trader, then or candle, then the candle is forming what the data based on the data. So you're reading the wrong data. So volume is relative. You think about that. We are judging volume from one bar to another. So have a way of analyzing the volume on a relative basis, meaning during the 30-minute time intervals, the first 30 minutes, if you can have analysis that during the first 30 minutes, this is the volume, and the history tells me this should be the volume. So compare based on the history, this is the volume, this first 30 minutes, and this is the volume on this 30 minutes. So something is going on with this. There's a high relative volume there. So there must be some some urgency there is there, and then you validate from other your own techniques, etc. To just don't jump on based on just relative volume. Pay attention to relative volume, pay attention to the time of the day, what time of the day. If the relative volume is high early time period, it has less meaning compared to the relative volume consistently maintaining it during the whole day. So for me, so if the relative volume is consistent higher during the whole day is more meaningful than the relative volume during the first 30 minutes, and then boom, nothing happened, and then I'm just sitting there. So I see 500% volume is trading during the first 15 minutes, and I jump at it. So what happened after that? Nothing happened. So I'm trapped. So I don't want to do that, especially avoid trading during the first 30 minutes. So pay attention to the time of the day and segment the time and volume. So I explained to you, segment the time and volume. So what time of the day it is, what kind of volume it is, what history it has. So do that, and then look for the validation or anomaly. So this is where the matching and mismatching I explained to you. Matching and mismatching. So look for the price spiking, volume coming in, price validated by volume, anomaly occurring, or so pay attention to all the validation and anomaly. So the volume, if the price is spiking, the volume should be, if the price is moving up, the volume should be moving up too. So I'll show you some charts. I'm running out of time. I have only 5 minutes. So I'll show you some chart and I will go into detail. So in some other session, I'll go into more detail about this. So this bar is wide bar. So if the price is wide, the volume needs to be high too. This is the average volume. The volume needs to be high. If this is a wide bar and the volume is low, it means somebody increased the price and there was not many buyers. So if the volume is building up and this is the shape of the bar above average volume, and this volume is validating the price. This volume is validating the price. So this is high volume and high price spread. So this is both in one line. So conclusion is the effect is in proportion to the effort. So the effort, the cause and effect. So the effect is the price and the cause is the volume. So price move is genuine, price is not manipulated, volume is validating the price. So think about it, volume is validating the price. So if the price, you're seeing the increase in price or decrease in price, the stock is going down, look at the volume, is it validating? If it's not, then that you need to ignore that. So market is bullish in the previous chart, and always, even if the market is bullish, but be suspicious. Look for some other anomaly, like 4 pens there, 3, 4, all 4 are red, but 1 pen is not lined up. So look for some kind of anomaly and see if you can find the anomaly. If you find the anomaly, then maybe you stay away. Now here's another chart. You see the bar is small. Bar is small, and the volume is small. So if the bar is small and the volume is small, the volume validates the price. So this is okay. If this is a bullish bar and the volume is low, so this is still okay because it's both matching. So if it's above below average volume, the price action is validating. The volume is validating the price. So there is no anomaly here. Validating. Now wide spread. So this is a volume anomaly. This is a wide spread. So if the spread is wide and the volume is low, this is anomaly. So then you say, okay, I need to get out of this trade. If you're in the trade, you're getting out, or if you're not in the trade, you would wait for the volume to build up. So sometimes the volume comes later, so you pay attention to later. You set the alert, some kind of alert, that you don't miss it, because there's a widespread, the volume is low. So you're looking for the volume to build up. If it doesn't come, then there's a volume anomaly and you stay away from the trade. So do that. So what is happening? Something is wrong. Market makers may be feeling the sentiment of the market. They raise the price, a gap up, the stock gaps up, and then there is no other buyers. So think about that. Large spread, high volume, validation. Large spread, lower volume, anomaly. So there was an anomaly here. And why has this anomaly appeared? So think about that. Ask question, why the anomaly is appearing, why the market is not joining in this price action, why the market is not joining. So if especially if this is a gap or the price moved up but there's no volume, so you need to ask why. So now there is this narrow spread and the volume is high. So think about that. There's a narrow spread and the volume is high. So what happened when the volume is high and the spread is narrow? Something is not right. So there's an anomaly. So it means whoever was selling it, whoever was buying it, somebody was selling it, somebody was buying and somebody was selling it. So the lot of transactions happened, a lot of volume, but the price did not move. So it means somebody sold into this. So there was someone was selling, even though the bar is looking bullish, white, but there was a huge volume. So somebody was getting out. So there was a distribution going on. So you don't want to go long into this trade. You have, because the price did not move. So you have, if you are in the trade, you would exit. If you're not in the trade, you wouldn't, because the volume is huge and the price action is narrow. So there is a volume anomaly going on. So you would be on high alert. So this is a trap. So battle by the big boys to hold the market top of a bullish trend. This could occur at the top of the bullish trend, especially gap up, etc. So uh, if this is a gap, so this is a different topic. If that was a gap, the volume is huge, that is a trap. So you don't need to go and get into that kind of a gap up. So, or if that the same candle, so think about it, what else has happened? So this is just an isolation, one bar. So you need to ask yourself, what else has happened before? So if this was uptrending market, so this is the exhaustion. But if this was a downtrending market before, so this could be a buying opportunity. So think about that. This could be a buying opportunity if the trend was uh, from here, the trend was a downtrend. So think about this. So that's why you cannot just make a decision just based on this one bar. So ask yourself what has happened before. If the market was trending, this is a bullish. If the market was uptrending, this is a bearish. So this is same bar, white bar. This could be a bullish or this could be a bearish, depending on what happened before and depending on what the volume is telling us. So volume was telling us what else has happened before. So when you combine all that, then you come up with the decision. So here it could be a bottom of a bearish trend, and further effort does not result in higher prices. So here that could be a top of a bullish trend and further effort does not result in a higher prices, or it could be a bottom of a bearish trend. So imagine a car moving up the icy hill road, and so if this is, you're going in an icy hill road, doesn't matter how much pressure the because the road is icy, the car is not moving up in the mountain. And in the case of a downtrend market, it should have been a large black candle. So if the market was is downtrending and the volume was huge, then this should have been a black candle. But this is not. This is a white candle. So it means there was a buyers here, and all the sellers got absorbed by the buyers. So what you do, you wait for another 1 day confirmation, and then you look for the move up. That is your entry, because you know that all the sellers were absorbed another 1 or 2 day, and now the action has begun. So this concludes the session on the price and volume analysis. There is more, a lot more into this. So you have to dig deep into this topic on your own. And I have the content. Maybe I'll teach some other time, but it gives you some idea. And I will see you. I have another session coming up at 6. I'll see you maybe on Sunday evening. And thank you.